Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Max Wasserman, co-founder and senior portfolio manager at Miramar Capital. He joins me to discuss why the market was overly optimistic on rate cuts and why there may only be 1 to 3 cuts for 2024. Max, it's great to see you. Welcome back to Trade Talks.
Thank you. It's great to be back.
All right, and let's talk about that, the Fed here. Why do you think the market was a bit over optimistic? And realistically, what do you think we're going to see for 2024?
I think Wall Street has a habit of trying to talk the Fed to go their direction. And they were hoping that, given the run up since end of October, when the 10-year came down from 5% to 3.8 in interest rates, they were hoping that the Fed would agree with that and keep inflation numbers low and then start cutting, which would give even more fuel to the economy and to the market. But you saw core inflation, the last print was roughly around 3.9% versus 3.7%. And we know that inflation's much more stubborn coming down from 4 to 2% than it was from coming down from 8 to 4. So I believe that interest rates will stay higher longer. And the Fed will eventually cut interest rates. We just think it's probably towards the end of the year. And maybe they'll do 25, 50 basis points cut. But I'm not looking for a great deal. And in fact, I don't think Wall Street should really want it. That tells us the economy's doing well, consumers are spending. Only time you'd see the Fed really jump in quickly for this like 6 rate cuts that everybody was anticipating is if the economy fell off the cliff, and it's not doing that. And we're seeing inflation still embedded. I mean, if you look at numbers like the rent, if you look at food inflation, which I like to exclude, it's still stubbornly high. But the economy's doing well. People are traveling, people are spending. We see that from the debt levels that are rising on consumer credit card. So we think the Fed is just going to hold out a little bit longer, make sure they get the inflation under control, and probably towards the end of they'll give us a treat. I'll call it a treat of like 25 to 50 basis points. But right now, there's no need to do it.
Right. Well, the fact of the matter is, if they were to cut too much and too often, then when they really would need to do something to boost the economy, they wouldn't have as many tools within their tool chest to be able to execute all that.
Yeah, I mean, think about this. The only thing that the Fed really has to watch is its debt level. I mean, the payment on the new interest rate debt is like astronomical because we have so much debt in this country. So with a rising interest rate, the fueling, the paying, the cost is going to cost more. And the Fed's going to want to bring that down. But right now, it just can't. I mean, because again, it's easier to wait and cut than to cut and have to turn around and raise it again because you didn't get inflation under control. So I think the Fed, finally Powell's getting the message to be cautious and wait a little bit longer. Again, 3 to 6 months really will not make that big of a difference. We know they're at the end of raising rates. So it's just a matter of when they start cutting.
Right. And speaking of another area that has seen a lot of optimism is certain sectors within the tech sector. Do you think that trade is over, it's run its course, or there's just too much optimism within that space?
Well, I think you're speaking in technology specifically about AI, and everybody is jumping on the bandwagon. In fact, when I listen to conference calls, if you mention AI, which seems every company out there is mentioning AI 4 or 5 times, it doesn't matter what they do. I don't care if they're serving donuts, so they're talking about AI. But I think what you're seeing is a lot of a pull ahead. Yes, we're seeing transformative technology, but the question is going to be really that much profit? Is going to be that much optimism in the bottom line? And right now, I think they pulled forward a lot. And we do have companies doing well. It is transformative technology. But again, you still got to profit from it, right? It's still a large investment. So I think the companies are strong, but they're a little bit overly aggressive. But again, as long as rates are low like this, as long as there's optimism out there, and the fact that these large companies are such a heavy weight in the indices, anytime you put money in the indices, it's buying the same stocks over and over again. So I do think it's a little ahead of themselves, but we like them, but they're very rich right now.
Right. So what other areas would you be looking at where perhaps valuations are more attractive, or there's opportunities that the market hasn't uncovered yet?
Right. I mean, if you take the top 10 stocks out of the S&P, the market's relatively fairly valued, roughly 15, 16 times earnings. We like companies in industrials. If we like healthcare, we like consumer cyclicals. Again, we're going to go a little bit away from it. Financials look attractive to us selectively. But we look at where we can get dividend growth. Again, we're dividend investors. So we're looking for companies that are growing their top line and also their bottom line in dividends. But we think, healthcare looks very attractive to us. We like industrials, like consumers, like financials. Financials look very attractive, but we look at financials much differently than just banks, right? And we look at healthcare much differently than just pharmaceuticals. But we like that areas of the market for valuation. We think it's much more attractive at these levels.
And finally, Max, you had mentioned before that heavy debt levels of the U.S. federal government are a concern. What other risk factors are you looking at from a macro perspective?
I think there's a couple things. One is you can never really understand or tell how foreign politics will really creep its way into our economies, right? So if you look at a blow up in China, the Middle East, or in Eastern Europe, right, that could have a short-term shock to the economy. You could have a cutoff in the straits, basically, and have oil interrupted. You could have more damage being done with traveling. So that we see as a problem. But again, we think that'd be a short-term shock. But we do see that political instability is rampant all over the world, and that has to be accounted for. But we believe that would be a short term and actually a buying opportunity. So if you did get a pullback, we look at it as an opportunity to step in and buy.
All right, Max, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.